Okay, guys, I am really excited about tonight's podcast or live stream, excuse me. So, right before the cameras came on, I started to ask Chris here how consequential this time period we're in right now is for your portfolio over the next, 3 months, 6 months, and possibly even a couple of years. So we're going to get into the possible directions of inflation, what the Fed may do with respect to monetary policy. So are they going to keep interest rates where they are? Are they going to lower interest rates? Could they possibly increase interest rates a little bit? And then most importantly, what does that mean for your portfolio? So the directions that the market could go or the economy could go and the possible reactions of the Federal Reserve is what is so consequential. And the Fed could really mess this up. And we were talking as we were prepping for the video, how bad it could be if the Fed really does mess this up. But there are also some possibilities for the market to actually respond positively, especially in the short term here. So I think this is one of the most important live streams that we've ever done for most of our clients and for you watching here at home if you're not a client. So I want to kind of start, Chris, with your opinion or your kind of analysis about where inflation is now. First and foremost, we've heard this from clients over the past several years. Are we possibly looking at a 1970s type inflation, early 80s, where we could be looking at 12, 13, 15, 18% interest rates as the Fed tries to get a hold of everything and tighten policy to bring that inflation back down? I think we all agree that that's not possible. That's not in the cards unless something completely unforeseen happens. But inflation could still go up, possibly, or no? Can we rule out the likelihood of big inflation increases from here?
I think so. So inflation's come down from, I think it peaked out about 9%, something like 18 months ago. It's declined symmetrically, much against what a lot of people on TV talk. They were talking, it's going to keep going up, it's going to stay high. That's not what happens historically when the Fed raises rates, particularly at the rates that they did, 75 basis points at a time, 3 or 4 times in a row. It calms inflation down pretty quickly. It's declined symmetrically down to, I don't know, depending on what measure you're looking at.
Well, the PCE came out today and 4.2%?
Yeah, and that I think overstates it because it weighs real estate and housing a lot more, which is very slow to react. So, the numbers we look at, it's probably in the 3 to 3.5% range. Can it, jump back up a little bit later on this year? Sure, because, commodity prices may tick up. But is it going back to 9%? Is it going back to 6%? I don't see that. I don't think Charles sees it.
Globally, Charles, China, Germany, what's anything happening over there that could possibly, that we don't see here in the United States, drive inflation a bit higher?
Yeah, if you take a little bit of a broader perspective and see what's going on globally, we're a global economy, right? So it has implications. If you look at one of the things we picked up a lot on earnings calls so far this latest quarter, it's just the expected stimulus from China coming back online has just not materialized at all. So you don't have that impulse driving, commodity inflation or even just any sort of manufacturing cost inflation. And then recently in Europe, one of the largest economies there, Germany, is teetering on going into a recession. And so these other factors globally are probably putting more downward pressure on inflation than they are creating a risk for upside surprise in inflation.
So if we don't see global forces, we don't see domestic forces bringing inflation up or taking inflation up, we have a couple of options here. Inflation stays high where it is and remains kind of at current levels for sticky for a longer than expected time, or inflation starts to come down. So first, let's talk about if inflation stays where it is, because this could be something that causes the Fed to enact more restrictive policy than we currently have, which could create devastating consequences. Truly, when you look at where the market says inflation is versus the academic approach to inflation, which is kind of what the Fed does, So let's say inflation stays where it is. We have a couple of outcomes. The Fed does nothing, keeps rates where they are, and maintains a fairly restrictive monetary policy, or they raise rates, maybe 50 basis points, maybe another 100 basis points. What do you think that impact has?
Yeah, I can't say it on live stream. It would be a train wreck, right? I mean, the data that Charles and I and the team looks at, real-time data, we've talked about this for years. We've talked about it a lot for the last 18 months. The real-time data says the Fed is already too restrictive on monetary policy. So if they decide they want to prove a point and take rates up even higher, they're going to cause bigger problems than may already be out there that have just yet to show themselves. I mean, we've been listening to conference calls for the second quarter earnings. Turn on the TV, you see the dollar store companies missing numbers, whether it's because of theft or because of not as many people coming in. You see credit card delinquencies going up. You're seeing the consumer in the United States, particularly on the mid to lower end, slow dramatically and start to ration where they spend money. So if the Fed were to raise rates 50 to 100 basis points more, particularly into the end of the year, particularly into the Christmas season, it would be bad for the markets.
And why would they? Okay, so so the Fed's preferred inflation gauge comes out today. It's the PCE, the Personal Consumer Expenditures metric, and it did increase a little bit from July, from 4.1 to 4.2 when you strip out the more volatile food and energy prices. But when we look quarter over quarter, year over year, it is trending in the right direction. So what could cause the Fed to, because they said it in the Jackson Hole speech, that they are not adverse to potentially increasing rates from here. So Charles, any opinions on what could cause them to raise rates?
I think the biggest issue is that, these are very, very smart individuals, but they're very academic in nature, and they're looking at backward-looking data from a very academic perspective, which gives them a different view on where the economy is, where markets are at, versus where capital markets are actually, in actuality, telling you where things are at. And in capital markets is where commerce is actually transacted. That's where the rubber meets the road. And so you have these two different disparate views, which is creating this great risk, because the view which the Fed is using to model these very important decisions is not really reflective of reality. And I don't think the consequences of that are fully reflected in the market.
In the more academic models and kind of a lot of the things that they're looking at.
And I'm sorry, and in listening, recent commentary by the Fed, and the chairman of the Federal Reserve referenced uncertainty so many times in his presentation, and to my mind, right, that's sort of the last thing you want to hear somebody say, even if they're a little bit unsure.
That's
you would
how
like
they feel.
right? You would like to at least hear some sort of a definitive view, right? I'm the chairman of the Federal Reserve. This is our view. This is what we're doing, and that's not what you hear.
So it was almost better when Greenspan was the Fed chair, right? Because no one really understood what he was saying, and if you actually understood, he said, "Hey, I must have misspoke."
Right. That's good.
So it's like we have these institutional investors, people who professionally work in capital markets. They're on this one mountain over here, and then you have the academics almost on this other mountain, and we're looking west, and they're looking east. And it's like we have these different views of what is actually going on with inflation. And operating in the capital markets, you have to invest money according to where the money flow is, right? But you also have to take into consideration what the Federal Reserve is thinking, what the Federal Reserve may do. So that does create some, let's call it delicacy, surrounding decision-making, capital allocation, and the requirement to be nimble and be able to pivot quickly if things change.
Sure. Well, the data that they're looking at and the actions that they take or have real effects on what goes on. But if you're looking at the wrong data set or you're uncertain about what's going on, that just creates a tremendous amount of risk and uncertainty, right? And capital markets don't like uncertainty.
Okay, so not many reasons really for the Fed to continue to raise interest rates. But Chris, if they do raise interest rates 50 to 100 basis points, you say it could be devastating. What does devastating mean for for you at home? Does that mean, bonds are going to crash? Does that mean stocks are going to crash? Yeah. Let's say the Fed raises interest rates another 100 basis points or 1% from where we are now. What possible impact could that have on the stock market?
Yeah, you'd want to own Treasury bonds because they'd be making a mistake, and they'd slow the economy's growth and inflation to a halt. But stocks will go down. I mean, they'd be too tight monetary policy. They would slow down growth. They would have to be thinking that the only way they get inflation back to 2% is more people have to get fired, right? Because we're a consumption, service-led economy here in the United States. Services is 70% plus of our economy. Their academic models say you need unemployment above 4.5% or 5%, otherwise inflation is going to be too high. So the last time, and I look people who watch our videos and YouTube stuff, I try to look at a lot of history not because history repeats, but because human behavior is pretty predictable. We tend to make the same mistakes time and time again, because in the markets that happens a lot because it's the same people managing the same money. They're going to make the same decisions. So there's kind of 2 points in time that look very similar to this. One had a great outcome for 9 months and it was kind of euphoria. The other one was a really lousy time period into Christmas. And the first one was the dot-com bubble. But not at the end of the bubble. It was kind of midway in the fifth, the seventh inning. So, the economy was chugging along, and Greenspan had been tightening in the summer of 1999, and then he realized with Y2K and a bunch of other stuff, I'm too tight. I'm going to be dovish into the holidays, and the markets went parabolic into mid-March of 2000. Didn't end very well, but it was sure a lot of fun for about 5 or 6 months. The other time period that is very similar to right now is leading up into October of 2018. Thank you. And I was here at Oak Harvest, and that was when Powell was raising rates, and he got real rates up to 4% thereabouts. And he just said, I haven't raised high enough, fast enough. I'm going to be hawkish. And the stock markets went down 20% between October and Christmas Eve in 2018, when he realized he was about to mess up the banking system into the end of the year and said, okay, I'm wrong. I need to be easy. So it's the first time in 6 years, short of a black swan like COVID, that there really are 2 very divergent paths coming up in the markets. And we sit here in September.
So I'm going to throw you just a little bit of curveball here. Because the most likely outcome, I believe it's safe to say, at least we see it in the capital markets, where inflation, anything you look out into the future in the capital markets, it says that inflation is coming down. Right. Okay? So what if the Federal Reserve, instead of just reducing rates, or let's say they keep rates the same, but they have more of a dovish tone at one of their upcoming meetings? And what they're really communicating there is, hey, we're not ready to cut rates yet, but they soften the language a little bit. So for your portfolio, for the stocks, let's talk about them because they have the most risk. What could that possibly do to the stock market?
That's essentially Goldilocks into the end of the year and the beginning of next year. As far as you'd have inflation coming down, you have earnings that have been coming in better than expected in the middle of summer, which is a very rare thing. And people would start to look out to 2024 with the spending that's going on with the government, with maybe a consumer that's still strong-ish enough, full employment. The markets, would rip. And they'd probably be led by energy stocks, technology stocks, consumer discretionary stocks, growth stocks.
So in that scenario, valuations are not terribly rich, but reasonably high. But you can see this inflection in earnings growth. And so if I can get, 12%, 13% earnings growth in 24, then I've got 12, 14% potential appreciation in my stocks broadly.
And then it's magnified probably by a dovish Fed with
Right.
cheaper cost of capital,
Right.
which could accelerate that, or at least some type of multiple of that earnings growth.
Agreed.
Which and something that we've talked about in prior YouTube videos is the presidential election cycle, the third year. We are in, the prime return cycle for the stock market presidentially. It's usually great between the fourth quarter of the second year, which was October last year, and it extends into the first quarter of the fourth year, which would be the first quarter of 2024. It all kind of sets up, with a crystal ball that no one has, but we all try to take data points and go, okay, is this the way it's going to play out? It all plays out very positively the way we sit right now. But it's summer, and a lot of things weird happen during summer. So,
Okay, so want to summarize here real quick, and then take a couple of comments. So, Geo Pepsi, I see you in Ohio. How you doing there? Renegade. So I went to Florida State, and Renegade is the horse. So Renegade says that he feels there's going to be a double spike in inflation and then possibly deflation. We'll touch on that for just a second. DeCenso, I see you there. How you doing, bud? And then there was one more here. Steve. Steve says, is inflation coming down, or is the rate of inflation coming down? And it's a good question. But before we get into that, I know Heather wants me to communicate that we are going to have a raffle upcoming. And Heather, when are we doing that?
At that 30-minute mark and in 1 hour.
So 13 minutes from now, we are going to do a raffle. And what are we giving away, Heather?
$100.
A brand new Lexus?
No, oh gosh.
Jeez. Nathan.
It's a what is it? A
Restaurant.
$100 restaurant gift card. So if you win the raffle, we're gonna reach out to you. We're gonna coordinate that and buy you dinner at your favorite steakhouse. Okay, so let's. I tell you what. I want to first. Can we real quick? Renegade says, and we have addressed this already, but I want to double back. Why again? Just quickly. Do we not believe there's going to be a double spike in inflation, meaning hit back up to 8-9% and then get into deflation, which I guess deflation would be good in that instance because coming from 9 back to 3.
Yeah.
Deflation is bad.
Yeah.
Okay. Deflation is, you do not want deflation in your assets. You don't want deflation in the economy. It's bad. The Fed will do everything possible for no deflation. They want small inflation, right? And your stock portfolio wants small inflation.
Yep. Yeah. The objective is price stability, right? And it's for a reason, right? So that you can plan capital allocations, purchases, all your decisions, whether it's from a capital allocation standpoint, if it's a corporate or from an investor, it creates a much better framework, and it helps. It's the linchpin of smoothing out these huge boom bust cycles that we had seen before. And so it's a legitimate rationale for why the Fed does what they do. What's interesting, I think, is that typically you don't see big, I can't understand why somebody would come up with a forecast that would have spikes, material spikes up and down. You'll get some volatility, but as Chris pointed out, it's generally pretty linear in how that unfolds.
And it takes time. Inflation takes years to really materialize throughout the economy.
Unless you pump $5 trillion into the markets with checks. The question on a double spike in inflation, I know where it comes from. It comes from looking back at the 70s because we had it, right? Arthur Burns cut rates, then he increased rates, and he kept Mickey Mousing around with stuff. The economy is very different than it was back then. We were almost totally dependent on Saudi Arabia and the Middle East for energy, and that's what was causing the material uptick in inflation. We are one of the biggest exporters of oil in the world. Now, we can talk energy policies, what's going on in Washington for probably an entire episode, but we're not going to. We are independent from an energy standpoint. That will help moderate any kind of energy price inflation over a multi-year period, not over 3 months or 6 months, because that's like a trading time period, but over a material time period of half a year to 3 years, we can bring on capacity. We can bring on new oil, new gas. You saw it. What everyone was saying. 200 oil after Russia invaded Ukraine, and oil peaked at 120 and went to $65.
Yeah, it's an interesting comparison would be to that time period where it was crude oil that we didn't have a whole lot of control over. Now we had COVID hits, supply chains get shut down, government gives everybody a bunch of cash, you want to buy stuff, you can't get stuff, right? And so prices skyrocket. So a large part of the decline in inflation we've seen so far, you could attribute purely to the easing of supply chains, which are operating just fine now. And so supply and demand is much more in balance. And so, and now you have second order effects that are beginning to take hold as a result of the Fed's actions previously. So it's very unlikely that you get a huge spike back. To Chris's point, different economy today than it was then.
Absolutely. And you have contributory effects on inflation, like the Russia-Ukraine war, also a transition from goods inflation to services inflation, and all things we've talked about in all the kind of podcasts and live streams before.
Yeah.
Steven has a really good question, and sometimes with just a comment, it's hard to necessarily interpret exactly what you're asking. At first thought, I thought it was a question of disinflation, where Steven says, is inflation coming down, or is the rate of inflation coming down? Yeah. So inflation is coming down. Like, we see that. Capital markets have told us that inflation is coming down for some time. But when we start to talk about disinflation, where the rate of inflation is decreasing, it's kind of, you guys can answer the question, but it seems like maybe both are taking place here.
Well, go ahead.
Yeah, you got it.
It's math, right? So inflation typically is measured as a rate of change. And so we've experienced some disinflation, which is not a bad thing, right? Because inflation was quite high, or the rate of inflation was moving up quite rapidly. And so now we've come back down the other side of that, experienced disinflation, that rate has come down. And so just by virtue of the mathematics, you've got base case effects that have caused that rate of inflation to come down. That's what people are really focused on. The issue now is, and perhaps to the viewer's point, is that these prices may stay high or may stay at this level for a while, but that rate of inflation effectively continues to come down because it's not changing. So the level of prices that we pay. And typically what happens is, over time, you get used to those. They become embedded in decision process, things you buy. Consumer tastes change. Corporations have time to review and how they handle capital allocation decisions. It's not a good thing necessarily. We'd all like prices generally to be lower, but you have the opportunity to adjust to it.
So we have two outcomes here, really. If we look at, let's say rates start to, or let's say inflation continues to either decelerate or come down. We have one, it's coming down, and interest rates are coming down because of something really, really bad happening in 2024, right? Let's say the Fed is too restrictive over the next few months, throws the economy into complete recession, the stock market crashes. Interest rates would come down as a form of ammunition to help spur economic growth and also hopefully provide some support to markets. So that's one scenario where the Fed gets too tight, markets crash, the economy goes into recession, they're forced to lower rates to stimulate everything. And then the second one is a more measured continuation of, let's say, disinflation or just a softer landing.
Price stability.
Price stability, a more gradual and acceptable movement toward price stability in the economy. And then the natural course of action would be to have a less restrictive monetary policy. So what happens, and what are some of the scenarios that could contribute to either of those taking place and some of the impacts? And most importantly, we always want to tie it back to you and your portfolio and your retirement. What should the viewers, what should you know about these possible outcomes and what the Fed may or may not do?
I see you looking at me. Hopefully the Fed realizes that they need to take a wait and see approach. And so let's see how things play out. Don't get overly aggressive, but you know, they get too tied up sometimes in game theory and what, you know, possible outcomes might be, and it's all based on these academic frameworks. I think the capital markets have told us, you know, you've gone far enough. Just sit on your hands for a little while. Let's see what transpires. And the economy's been very resilient. But to Chris's point earlier, regardless of what shows up in some of the economic data, you listen to what Walmart says, listen to what Dollar Tree says, listen to what Home Depot says, right? People are, although those companies continue to do well, they are shifting how they run their business to suit consumer demands, which are definitely shifting down towards must-have items, or shifting from name brands to store brand items, everything that they can possibly do to save money.
Yeah, I mean, it gets back to the Fed talks about it. People on TV talk about it all the time. I've had all the economics class. I've got the MBA. I hate to talk like an economist, but it comes down to lag effects. And is the Fed willing to wait and see what their 525 basis points of rate increases have done, and how long are they willing to wait? Yeah. And you know, Alan Greenspan raised rates very quickly in 97, 98 into the end of the year, and then he slowed down in 99 after he created the tequila crisis and the Mexican currency crisis. You know, are they going to slow down? Are they going to stop with the verbal diarrhea on inflation and everything else and let it play out? Because they are at the point that they can cause a serious issue in the economy, which would be a problem for the markets, sure. At least in the stock markets, right? The treasury markets would actually like a slower inflation, slower growth.
To take that a little bit of a different tack or track, you might think of it this way: is that, you know, if you now put savers in a position where you can actually earn a decent, you know, something above 0% on, you know, a bank CD or in your money market fund, and that's potentially the good news, if you will. But the bad news is, if you're a consumer, right, your credit card bills go up because the financing costs there are higher, your home mortgage goes up, you know, your car loan goes up. So it certainly has puts and takes that have to be considered for our clients in terms of where they're at in terms of their retirement plan and such.
And that does tie back to, so we have the raffle guys coming up in about 2.5 minutes here, but it does tie back to what we talk about all the time with step one of the retirement success plan, where once you understand what your needs are from a spending perspective, what your asset base is, and you build that allocation, how much should be in bonds, how much should be in equities, how much should possibly be in real estate, how much should be in more secure tools, and you build that allocation, and then you model it out through stress testing, essentially, to where if the stock market is down 20, 30, 40%, do you still have enough of an asset base to generate the income to not be afraid of running out? And that's really what the retirement planning component is, where these things are taken into consideration when you have a properly constructed investment portfolio that's looking at your income needs and the growth of those income needs over time. But to your point, which ties in over here to a question that Dan asked, we're going to get into, Dan, thank you very much for submitting your question through the live stream here. Also, thank you, Dan, for submitting a question prior to this. We did see that. So we're going to come back to Dan's question right after the raffle. But Dan says, bottom line, in the next 3 to 12 months, is that a good time to move from high cash fixed income allocation? I think he's saying high cash, like money market rates, Dan, I believe that's what you're saying, into more intermediate and longer term bonds to capture gains if interest rates go down as expected. So to summarize, and we're going to do the raffle, and Charles, you and I talked about this a little bit prior. Love to get your opinion and then have Chris chime in. Dan's ultimately asking, hey, rates could theoretically be going down. Should I start to buy intermediate term and longer term bonds and get out of my, cash accounts, or maybe shorter term fixed income here? So Dan, we're going to answer that question right after the raffle here. So Heather, we're going to go ahead and do that. So again, we're doing a raffle, and it's a $100 gift card to your favorite restaurant if you win. The team here will reach out and coordinate all the details there.
Tim Kahn. Tim, K-U-H-N. Tim.
Tim Kuhn, K-U-H-N, Tim Kuhn. Okay, Tim, we're going to reach out. Our marketing department will reach out and coordinate the delivery of that gift card to you. I want to thank you very much for registering, for tuning in, and hope you enjoy it. Get a steak for me. Okay,
So
go ahead.
to Dan's question, yeah, it's been great. Money markets offer very attractive returns currently that we haven't seen in quite a while. But if we sit there and look at the scenario that we've drawn out, we say that there's a possibility that the Fed may raise rates a little bit more. We don't see them raising rates a lot. There is a chance, hopefully, higher probability they begin this process of either leaving them alone or lowering them. So the best course of action is certainly not to go out into any sort of longer dated fixed income, because they actually pay the shape of the yield curve, or how much you get paid for extending out farther and farther, or tying up your money for longer and longer, actually goes down. So the thing that we think would be best is just stay in 1 or 2 year Treasury securities, and with doing so, number one, you lock in effectively that higher rate for the next year or year and a half. And should the Fed begin to lower rates, right, the first order of impact is going to be in money market funds, which are immediately going to see a decline in the yield that they offer. However, if you've invested in a 1 or 1.5 year Treasury note, you're going to continue to receive that same high yield. Okay, if in fact you do that, but the Fed raises rates a bit, 25 basis points or even 50 basis points over the course of that year and a half, then when your bond matures, you would reinvest it in higher yielding securities at that time. So you take very little risk you take way too much risk by extending too far out on the curve, where just staying in shorter dated
You're not being
securities.
compensated for
You're
it.
not being compensated
Yeah,
for it.
ultimately, and if things go in the opposite direction, you're going to be punished for it.
Right.
Yeah, and so Dan, this is generally speaking, this is not investment advice. Please do as you please with your money, but generally speaking, we feel that the compensation for going further out onto the yield curve there,
Yeah.
increasing duration, the compensation's not there.
It's just not there. Yeah, you don't want to be paid less for tying your money up for a longer period of time. And it was a hard lesson learned by a lot of folks when the Fed began this process of raising rates. 18 months ago, many advisors had caused their clients to extend very, very far out on the yield curve. They were stretching for yield. And I don't think those folks, and maybe even the advisors at that time, realized the level of capital appreciation or depreciation that would occur if market rates rose.
Yeah.
And so lesson learned there.
Bonds aren't safe, right? They're less risky than stocks.
Right.
And theoretically, your United States Treasuries are the safest investment out there. But in the interim, before they mature, if you have a 20-year bond, you could lose 30, 40, 50% of your principal while waiting for that bond to mature. And if you need that money to live off of, to do this, do that for emergencies, well, you're in a bad spot. You
Agreed.
can't just sell it without incurring tremendous loss. So let me play a bit of devil's advocate here, because I think I kind of know where Dan's coming from. So, and Dan, feel free to type in the box here if I'm interpreting incorrectly here. But in Dan's mind, because I talk to a lot of people and I hear this often, Troy, well, if I could lock my money up for 20 years at 5%, why wouldn't I do that? Why not do that? If all I need, I'm retired, and if the government's going to pay me, 4% or 5%, that hits my goals. Why not do that?
I mean, I think when I look at it, right, from the investment department standpoint, I'm always looking at the shape of that yield curve to see where I'm earning the highest return over the shortest period of time, because I don't want to have to have my money tied up for a longer period of time if I'm not earning the return on it. So I'm always looking to optimize return. Now that's my viewpoint from the investment manager standpoint. That might be a little bit different from a financial planning standpoint. What I do know, however, is that many of those bonds are offered and are used by folks like insurance companies that have specific liabilities that they're trying to match up. And that helps them match their assets and liabilities. And their intention is to never sell that bond over the time that they own it.
And that's what it comes down to, is time horizon. If you don't need your money for 50 years or 100 years, like insurance companies, for example, and you can accurately predict into the future of when you're going to need that money, then it makes sense. Mm-hmm. The problem is in retirement, for most of us, when we're considering capital allocation or how to invest our money that we've worked our entire lives for, anytime you lock your money up into an investment for 20 years where you could potentially lose 30, 40, 50% in the short term as the market value fluctuates, who knows what inflation is going to be in 12 years? Who knows what interest rates are going to be in 12 years? So if you need that money in 12 years, you could be looking at, if you invest $500,000, maybe you need it, you might get $200,000 if you need to liquidate it at that point. Just an example, but there's so much uncertainty is what I kind of fall back on is when you have something that can fluctuate so much in value while you're in the holding period, you introduce a tremendous amount of risk. And more importantly, Dan, the risk is consequential. Let's say it's your health. Let's say it's your spouse's health, and she needs to have some type of care that's not covered by insurance, or she needs some type of care that maybe it's, I guess you get my point here. So you just introduced a ton of uncertainty, and if you have $18 million and you're talking about $1 million, well, sure, kind of like a barbell approach to a bond portfolio could make sense because you're not going to need that money. So just we need to be thinking about the potential outcomes and what those impacts on our portfolio in retirement could be. Okay, we're going to move to what is the Fed really trying to do. Before we do that, guys, any thoughts on what we've just discussed regarding the market, what the viewer at home should know, or anything else?
Fed seems to be very academically oriented, looking at government data, right? We're thankful, the government spends a lot of money. They create and survey and produce a lot of really interesting data about a whole lot, just a whole litany of things. And I'm sure that serves some great value to someone. However, as it relates to capital markets, right, if you've got the head of the Federal Reserve and this board of governors who are very academically oriented, looking at backward-looking data in an academic perspective, which has very material differences from how actual capital markets are behaving, you've induced a lot of risk into the system.
Yeah, I mean, they were looking at academic data, and it caused them to be 12 to 18 months late on recognizing there was inflation in the system.
Right.
So, they're looking at the same data. Hopefully they learn from that mistake and are like, okay, let's anticipate a little that what we've done over the last 12 months is going to cause some issues, which, I mean, it is. We've been listening to conference calls, and the consumer is not, even though there's full employment and the employment markets are strong, they're not as strong as they were 6 months ago. The job opening rate has declined. Hours worked is declining off their peaks. So they need to slow down and see what traffic shows up.
Right. The lag effect. There's uncertainty. And he said it in the Jackson Hole speech.
Yep,
There's so much uncertainty about the lag effect.
Without a doubt. And the one thing to remember, if you can, we can impart this to our listeners, is that, capital markets are forward-looking, right? They are forward-looking discounting mechanisms, and therefore, and they're very dynamic, and therefore it is a futile task to try and use backward-looking data to manage a forward-looking capital market.
And then, and I guess theoretically here, the Fed is trying to, of course, their mandate is to hit this 2% target.
Right.
Whereas we're trying to reduce risk inside of investment portfolios to achieve certain objectives in the financial markets.
Right.
So you have these kind of, I don't want to call them diametrically opposed, but ultimately, let's call people in the capital markets and the economists who are targeting through monetary policy a certain rate of inflation, really almost, it's like a tug of war, right? But only one person is pulling because they're controlling the complete directional impact of capital markets, or the impact of their decisions on capital markets. Do they even care, do you think? How much do they care about capital markets versus their mandated 2% inflation target?
Right now, I don't think they care at all.
Yeah, it's a great question.
I don't think I don't think the people who are sitting on the Fed board care at all about, really what level the S&P is. Under the last administration, we had, President Trump talking about the S&Ps at this level. I don't think this administration certainly doesn't care. Our current Fed, I think they care kind of anti. If the market goes up, they're afraid it's inflationary. People are going to be too happy, spend too much money. But right now, they're not focused on anything really more than inflation. And they've said it. They've said in prior speeches that they think the way to get inflation down is to get unemployment up, to 5%, which is just insane to me.
So many families hurt.
Oh, back on payrolls that taxpayers are paying for, as opposed to private companies paying wages. So it doesn't make any sense to me.
So it makes me think what's important that we do for our clients is that we're constantly looking at this, and we're trying to optimize everything we do to be forward-looking and take advantage of what capital markets are giving us, as opposed to just blindly listening or a 30-year bond has 10 basis points more yield in it than a 2-year, so let's just buy that 30-year bond with complete disregard for everything else that's going on that might cause huge losses of capital in a client's account. We're like, okay, here's the situation we're given. Here's the risk reward of every asset class we look at. Let's shift what we do into those asset classes and those specific segments of it that offer us the highest risk return in our view. I mean, we're not always right. We're the first ones to admit that, but at least we're trying to effect a thoughtful process that gets us with a good batting average. That's all we need is a good batting average.
So it part of the question here, and I know we've kind of deviated a bit from the intended course of tonight, but Dan, you bring up a really good question. But it brings me back, honestly, to a prospective client that came in, I'd say probably 4 or 5 years ago. And I don't know if you guys have ever heard this story, but they came in and they told me that in 2008, they lost half of their retirement money. They were still working, but their 401k turned into a 201k. Mm-hmm. And they said, Troy, that scared me so much that I took all of our money after the losses. I felt like I should preserve and protect what I have left and just put it into cash. And emotionally, I was so impacted that I stayed in cash all the way through 2016, 2017. So they came to me, and in between a first and a second visit here, what we do is we run an analysis on the risk in your portfolio, how much income can be generated. We create a tax strategy. We do all of that. We come back on that second visit, and what happened when I came back with this family was they told me that we want to be aggressive. Okay, we feel like we've missed out on the past 10 years of growth, so we want to be aggressive. We want to have a very heavy equity allocation. Now, I have enough experience, and I've been doing this for long enough to where I know someone who sells all of their stocks at the bottom of the market, and then 10 years later, when things are going great, they're suffering from FOMO, fear of missing out. They want to get it all back in. It's literally the absolute worst time to probably invest. It happens. I mean, we talk about this all the time, but more than that, it was inappropriate for their needs, because our analysts, when they were in between the first and the second visit and they were going through what they actually needed to achieve from a rate of return standpoint, it was 5%. even though they had missed out on the tremendous wealth creation opportunity from '09 to 2017, and they lost half their money in 2018, they were still saving, they were still contributing to their retirement accounts, and they had very modest spending needs. So we came back and we started to go through the analysis and say, hey guys, look, everything that you've told me you want to do, the spending, the increased amount of spending, the first 10 years of retirement, all we need to do is target about a 5% rate of return here, and we do not need to be 100% equity. He said, Troy, I want to be 100% equity because I don't feel I have enough money and I feel I've lost too much over the past 10 years. So I looked at him and I said, at this point, there's nothing more I can do for you. I don't think we're a good fit for one another. And we had a conversation for about 10 more minutes and he left the office and I've never heard from him again. But the point is, 2020 hit a few months or a few years later. I can virtually guarantee that he did not stay committed to his investment plan during 2020. And if he did, 2021 was a great year, but 2022, when the market crashed 30 to 40%, I guarantee you he did not stick to his investment plan at that time. So when we get into financial planning and we get into why we do what we do in retirement, the investment stuff is important. It's step one of the retirement success plan. But what's more important is what is the appropriate allocation for your money based on your spending needs, your longevity, your goals, your objectives. And crafting that portfolio, it could be 20% exposure to stocks. It could be 60%. It could be 75 or 80. It could be spending 5% of your money for the first 6 years or 8%. Well, 8% is probably a bit much. Maybe around 5.5% maybe for the first 10, and then we taper that back. The point is having a customized income plan, but then an allocation, an investment strategy that is tailored to your particular situation. And then using this knowledge and what we talk about here on the live stream and all the podcasts that we do on an ongoing basis, using that information to adjust based on your life changes, dynamics in spending that may change, and your goals. I mean, I can't tell you how many times a client comes aboard at age 62 and then at age 67, they come in and they say, Troy, you know what? I'm just not as aggressive as I was a few years ago. I really want to dial this back. Well, we're going to adjust the portfolio, but we're also going to look at the spending. And I bring this up because Dan's question kind of triggered that. What you were talking about a little bit ago kind of triggered that. And I guess I want to convey just to you at home right now that it's not necessarily about what the stock market is going to do over the next 6 months or 12 months or 3 years or what the bond market's going to do. It's about having the portfolio constructed according to who you are, what you're trying to spend, what you want your life to be like. Do you want to watch the TV all day, financial news, and stress about which direction the stock market's going? Or would you rather have an income plan in place that the stock market could lose 40% tomorrow and your lifestyle doesn't change? That's the type of person that we work with. That's the type of person that we enjoy working with. And we just believe in our hearts that that's how you should approach retirement. Because the stock market could go up, the stock market could go down. We can't control that. We can make our best investments and guesses and directional decisions, but it's all out of our control. I mean, everything we've talked about tonight is how people in capital markets are looking off this one mountain to the east, and then the Fed is taking this academic approach, looking over here to the west, and there's this reconciliation that needs to take place, but ultimately, it's your money in retirement that's at risk, and the goal is to protect that, to preserve that, to develop an income and tax strategy that works for you. So Dan, I get passionate about this stuff, and you asked a really good question, and maybe it doesn't have anything to do with the story that I just shared with you, but to me it does, and to our firm it does, because that's who we are and that's what we do. Okay, moving on to what is the Fed really trying to do, and I want to we're going to shorten this segment. And we want to kind of keep it high level here, but we're going to go through this, and then we also want to talk a little bit about, we're going to finish the story about Q4 and also the first half of 2024. We're going to talk about based on what the Federal Reserve may do with interest rates and how inflation could impact that. But for you, possible directions of the market in the fourth quarter of this year and also the first half of 2024. Completely hypothetical. It's a discussion about what could happen based on certain choices the Federal Reserve makes and the path that inflation could take. But first, Paris, what is the Fed really trying to do here? Are they really being truthful, or there's not some sinister objective here, but
They-
what is it that they're actually trying to do?
I guess they're trying to do two things. First and foremost, they're trying to regain their reputation, which I don't know if they can do that. But mathematically and economically, what they're trying to do is get a real return back in the treasury market. So, we've had some podcasts in the past. When you buy a U.S. Treasury bond backed by the government, when you turn on the TV, you'll see the 2-year Treasury yields 5% right now. That's the nominal interest rate. It's composed of some part that's inflation and some part that's real growth, or your premium that you're paying to own that bond. After the great financial crisis, the Fed basically had cut rates to zero for almost a decade. And the real component to you owning a treasury, you owning a U.S. government bond, was zero. And actually, at some point in time, it was negative 4%, given where inflation was. They have gotten that above zero. The numbers they look at right now say they're not yet at 2%. The data we look at in real time says they're actually already too tight. In the short term, they're over 4%. If you bought a 1-year Treasury note right now, the real return relative to inflation in the market is around 4%.
It's positive.
Yeah, it's
Based
positive.
on the capital market perspective, not
Correct.
the Federal Reserve's
Right,
perspective.
not the academic models and the textbooks.
Yeah. So, Charles, I'm going to come to you in just a second. We're going to talk about why they're doing this, or what's to continue on what Chris said here. But I want to explain a little bit what Chris said. So, the PCE, which they say is the Fed's preferred metric for inflation, if that, which it is, it came out today at 4.2% when you strip out the cost of food and energy. If it's at 4.2% and inflation, let's say, is at 3%, you have a spread right there of about 1.2%. So that's your real growth. I guess I did that backwards. So bonds minus the inflation rate is what we call your real interest rate. So if bonds are paying 5% and PCE is the preferred measure for inflation is at 4.2, you'd have a spread of about 0.8. So that is what the Fed is looking at for their preferred measure of real interest rates. Whereas capital markets, everything you guys are looking at is saying real rates are probably closer to around 2% right now.
It depends on how far out you go. 1 year, it's 4%. If you go out 5 years, I think it's over 2 already, and if you go out 10 and 30 years, it's around 1.8 to 2%. The capital markets are saying the Fed is tight enough and they should stop.
So real quick, what does this mean for those at home? Because real rates gets very confusing. I mean, you just heard me. I just said it backwards. I mean, it does get confusing. Yeah. And what makes it even more confusing is you have all these different measures. So you have core inflation with the cost of food and energy. You have the 1 year rate. You have the 2 year. You have the 10 year. You have all these different variables and all these different metrics. Charles, what is the Fed really trying to do here?
Yeah. So going back to what you said earlier and how rates were brought down to near zero levels for so long, put the Fed in a position where there was very little that they could do in way of handling any future economic problems, right? There was no ammunition, right? The ability, if needed, to stimulate the economy was basically zero. It's kind of like pushing on a string, right? You got nothing left.
Well, let's just kind of start from the beginning here. How does the Fed help whenever the economy struggles?
Yeah, by lowering interest rates, which then lowers the cost of capital to consumers for things such as owning the primary mechanism via which the Fed uses to transmit its policy through the economy, lowering interest rates, which lowers your mortgage interest rates, the ability to purchase a home, typically someone's largest investment. But it also affects those credit card rates that you have to pay, auto loans, so it makes things more affordable. And so you go out, you can afford to buy more stuff at the margin, and it stimulates economic activity.
Okay, so the Federal Reserve fights recession by lowering interest rates, by making the flow of money kind of more fluid, easier to kind of flow throughout the economy.
Right.
So you're saying when interest rates were at 0.5, if we entered into a recession, it's like they have a 6-shooter, but one bullet in the chamber.
Right, kind of got nothing left.
So now interest rates, they've brought interest rates up much higher. But when we're talking about the real rates, which is kind of the spread between where bonds are or where interest rates are and inflation,
Right.
they've brought all this higher. So really they're trying to hope inflation comes down. So you have this spread here of the real rates of technically growth in the economy. And when we have growth, but interest rates are also still at 4 or 5%, and we go into a recession.
Right. Now they have ammunition to stimulate the economy again. So it's a good thing, in theory, right, what they're doing is good. In a period of which we had strong economic growth, that's the best time to raise rates. Well, they decided, when they decided to do it, they decided to do it in very short order and in very great, quantity. And the fear is that they've gone too far.
So they're trying to achieve a moderate pace of growth in the economy while also having ammunition in the tank in order to spur the economy should some type of calamity or unforeseen event take place.
That's exactly right. Yep.
I am pretty good at this.
Yep.
Great summary.
You're going to be you'll be our write-in candidate for the next chairman of the Federal Reserve.
Let's do it. Okay, so we have a good question that came in
it's a
here,
great
and
question.
Chris, I'm going to throw this over to you. What are they? Excuse me. Do you know who wrote this?
It was emailed in.
Oh, it was emailed in. Okay. So a question, we do not know who this came from, but it's a really good question. We want to address it. What are they hearing, or what are they as you, what are you guys hearing regarding, on the conference calls, regarding employment expectations in the near term and long term?
We saw not a lot currently to answer the question, but you just rewind the tape a little bit, and we saw, particularly within the tech sector, a considerable degree of overhiring that was predicated upon the belief that so the growth in some of these firms that we saw was going to continue, right? And so there was a lot of excess within the tech industry in particular, so we saw a lot of layoffs there. Things have stabilized a little bit. As much as anything else, we're seeing fewer quits, people quitting their job. The market has tightened up a bit, but from what I've heard listening, companies are now going other directions. You don't hear a whole lot more about layoffs and headcount reductions.
Yeah, we didn't hear that much on calls about layoffs, but the real-time data is it's weaker, right? The way most companies hire in America now is, they hire full-time last and they fire full-time last. So the flex is temporary employment. And if you look at the temp jobs and the hours worked, all that data peaked 6 months ago, 9 months ago, and the number of temporary workers has been declining. The hours worked has been declining. It's summer, so it's really hard to tell, if it's going to continue into the fourth quarter. But it's a great question because the leading data, which the Fed, for whatever reason, looks, doesn't look at, I guess.
Yeah.
It's slowing, and it's slowing pretty quick, right? I mean, and this gets back to the news you see on TV. You don't have people robbing dollar stores when the economy's great, right? I mean, it's just, anecdotally, one of the things I try to do is when I go out and I fill up my tank, and luckily,
Don't tell me you will keep a spreadsheet.
No, I don't. But that was my dad, and he still probably does it. At 90. But no, when I go out and fill up my tank, which is usually at Costco, I look at the gallons. And particularly when I don't go to Costco, if I'm going to Valero here in Houston or some other place, I'll look at whoever got gas before me, and I look at the gallons.
Wow.
And I look at the dollar figure. And when it says something under $10 or 3 gallons, the economy's not doing great, right? Because it's that the lower end, of the economic in society, that they're struggling. And whether it's because of inflation, whether it's because the economy's slowing, we can make up excuses, but you don't want to see that, and that is going on right now, during the summer.
It's one of the primary ways we use to select stocks here, right?
I'm not sure where you're going with that, but we collect a lot of data from a lot of different sources, but I'm not sure how that.
The ratio of $10 in above.
Yeah, but so
in gallons of gas.
I guess on the other end, in listening to conference calls. Some of the high-end liquor companies have been reporting, and they've seen a dramatic drop-off here in the United States in unit sales. That doesn't happen when the economy is going great. I mean, you don't have champagne sales declining when the economy is going great. And when the truly rich are cutting back, they're usually concerned, right? And that's what's going on right now during the summer. Do I think it's a problem right now? No.
I know bourbon sales are not declining, so
they
still can't find that
units
anywhere.
are. Units
Not here
are.
in Houston.
Yeah, units are. Units are.
Okay, so real quick, this ties in. I don't want to spend too much time on this because we just hit our next raffle. The next raffle is coming up in 60 seconds. So I want to bring this up because this was a two-part question, and we just went through the first part from the email, and I think there's some irony here because it says a quick uptick in layoffs and then combined with higher rates, and suddenly the economy seems very shaky. Well, that's almost what the Federal Reserve is trying to do, right? They literally said they're trying to reduce or create. Well, go ahead. Guys.
Yeah, you're exactly right. It's such a, right? It kind of goes back to harp on the point, this academic exercise without even thinking about what the sort of the social, consequences are, right? Well, what do you need to do to get the economy back, right? We'll make sure a whole bunch of people lose their job, right? Seems pretty
And this is the purpose of the entire first segment, because the Federal Reserve is taking this academic approach to get inflation in line, but then you have this real human aspect with not only jobs and families, but financial markets, your 401k, your retirement. And the Federal Reserve is more focused on the economy and inflation. And if this is why it's so consequential, because if they keep this approach and keep rates high for too long, or possibly increase rates, and they could throw this market into a crash, they could throw the economy into a complete recession, and it might not just last 3 months, it could last a year, 2 years, 3 years. This is one of the most consequential periods for the next 3, 4, 5 years. What happens? And this is why paying attention to it and being able to adjust and understanding the question you ask here in the email, it's counterintuitive. Like, why would they do this if it's going to cause us to go into a recession? Well, the simple answer is because it'll bring inflation down. We'll get to real rates at their target expectation or target, and then to hell with markets, to hell with your retirement, to hell with the economy. We've hit our mandated 2% inflation target, and now we have ammunition for the next recession, which we're currently in. Then, of course, they need to drop rates, and then we're on the hamster wheel, and it's. I'm not going to say what I think it is.
Right.
So but that's it's a possible outcome, but it's also possible we have a softer landing and rates come down gradually. So just understanding some of these dynamics, that's the purpose of this live stream and also what we do on a day-to-day basis. So I want to give you guys obviously the chance to respond before we get into fourth quarter potential directions and first half 2024 way too early outlooks, but I owe you guys a raffle winner. So Heather? Alan Adams. So Alan, congratulations. Thank you very much for registering for tonight's live stream, and also thank you very much for tuning in. Our marketing department is going to reach out to you and coordinate the delivery of this gift card, and also enjoy the steak on us or lobster or Mexican. Down here in Houston, we have amazing Mexican or Italian or whatever it is that you choose to enjoy for dinner.
It'll help the gift card will help combat inflationary conditions by providing some extra cash.
Yeah, just don't throw us into a recession here by contributing to sustained high purchasing prices. Okay, guys, you want to respond to that, or you want to jump into first or Q4 and possible 2024 outcomes?
I like the second half. I mean, let's talk about that. I mean,
okay, so what do you like about the second half?
I mean, we've written about it already, and whether people like it or not, year to date 2023 has been as exact of a normal year in the markets for a presidential election when the Fed's raising rates, when the economy's slowing, as there's ever been. I mean, almost to the day. You know, I wish Charles and I were running a hedge fund or running a, yeah, because, you know, if you weren't worried about taxes, if you weren't worried about a lot of things that we do have to worry about in client accounts here because we run SMAs and stuff, there are lots of opportunities in individual sectors and stuff and individual stocks. There's massive diverse returns this year. There's been, I think it is the most separation in sector returns since 1998 and 1999, which was at the midterms of the internet bubble. So I think unless the Fed does something crazy, or there's a black swan, which you can't predict unless you're on CNBC, and then you predict them every month for 15 years and get one right. You know, we're in the summer. Summer, it's played. You normally peak in mid-July. You normally, you know, kind of go down into mid-August. You go up into the beginning of September. You'll go down 4 to 6 weeks into mid-October. They come up with reasons, excuses. I don't know why they'll come up with another one this year, but right now, you know, we're in the summer, and right now, unless the Fed does something crazy in the next 6 weeks to 2 months, the fourth quarter would be good, and the beginning of next year would be really good.
So let me set the stage real quick, or at least summarize. We have in the capital markets looking forward, they're already telling us that inflation is under control and inflation is not a concern, correct?
It's headed the right direction anyways.
Headed in the right direction. So the likelihood of the Federal Reserve increasing interest rates because of inflation spiking, we feel, is pretty small. Okay.
Correct. Yeah.
So the question now becomes, does the Fed keep interest rates the same with a hawkish tone or a more dovish tone? And then also, do they possibly, which we don't think they're going to do this year, I think reducing rates is off the table this year. So it's more in the language of the Federal Reserve. So they may, I mean, God, what if, we don't want to get into it, but I'm thinking, what if they raise 25 bips with a dovish tone? That would make no sense, though. But let's say they keep it level with a dovish tone. We could see a blowout fourth quarter. No?
Sure.
Theoretically,
that's generally the look and feel that we're starting to get based upon previous experience and everything that Chris has outlined.
Yeah, the stock market cycles is so. I guess they have a meeting coming up in September
20,
and they have one at the very end of October. If they don't do anything coming up in September, which I don't think they will, and the data continues to kind of weaken, and they start to talk more dovish into the October meeting, there's a high likelihood, short of crazy stuff going on, that, you know, Thanksgiving through Christmas is a big up move. We may get some pullback at the beginning of the year because people sell stuff for tax reasons, and the first quarter would be, you know, parabolically potentially up. That's what happened in 99, 2000. And the economic scenarios looked very similar. Greenspan was very hawkish up until October of 1999. He was concerned about Y2K. If the Fed was looking, I think, at market statistics, they would be concerned what may happen in the banking system at the end of the year and just tone down the dovish stuff, tone down the hawkish stuff and go dovish, and let the stock markets do what they're going to do. You know,
that's what Greenspan did, right?
That's what Greenspan did. Yeah. It wasn't fun 2000 on. We had a lost decade because he, you know, raised rates, and there was a huge dot-com bubble in spending, which we are seeing some of that going on right now in AI and artificial intelligence. given the numbers that are being reported at a couple companies. But it doesn't look as widespread as it was back in 1999 going into the internet bubble peak.
So Diamond Mohammed here asks a question. It's actually kind of an oxymoron, I guess. Why not go for aggressive hedged investments? Well, Mohammed, I guess it's technically, if it's hedged, it's not aggressive, right? Because aggressive tends to be
Right.
reduction in risk if properly structured and managed. Because you could be, 100% in the most risky asset, but if it's hedged, it's not aggressive because the risks that are inherent within that asset class are hedged out. I think what you're saying is why not invest in something that has potential to participate in the upside of the market, but also has protection against downside risks. So that's it's a good question. I mean, there's tools out there that can do that, and I just wanted to kind of clear that up because it ties into this next question here, Missouri. What are your thoughts, Paris, on buffered ETFs?
Hate them. Think they're a waste of
Oh
time,
my
waste of
gosh.
money.
Yeah.
Hang up the phone.
The financial community, it has.
He asked me. No.
Yeah. Okay.
I've
what he said.
researched them.
Yeah. I think-
know math. I'm sorry. I've got an economics degree. I do have an MBA. They're sold to you. They're a waste of time.
Yeah, I think the financial markets or the financial industry has a very unique way of creating product that for a perceived need and then just trying to shove it down everybody's throat, and it's completely worthless.
And I'll tell you,
Charles is much nicer than I am.
so I'll tell you what. Here's my experience with buffered ETFs, and obviously I understand financial markets and products and kind of what's going on out there. I came to this guy one day and I was like, Chris, it sounds like a pretty good deal here. Where our clients are protected 30% the downside. If the market crashes, they're not going to lose anything. They can make, I think it was 20% or something like that. He's like, Troy, you didn't read the fine print.
Yeah.
He's
Well,
like, if the
this
market
is after
drops
I read
below
it.
a certain level, I think that 30% buffer or 20% buffer, your client gets 100% of the losses. So yeah, theoretically, I guess they could take up maybe a teeny tiny portion of someone's percentage, but
right.
I think what you guys are communicating is the way they're sold is that your principal will be protected in this, crash of a market, when in reality you could end up with 30%, 40%, 50% losses and be pretty pissed off.
Yeah.
Read the fine print.
Yeah.
That's the main thing. Is because
But you can't even read the fine print because if I don't understand it,
It's
the
so
chances
tough.
of them
Yeah.
understanding it are very, very small.
The common theme among just about all these products is just when you need that protection the most is when it
gone.
fails.
Yeah, so if you want protection of principal, consider a fixed indexed annuity or a fixed annuity from a highly rated carrier there.
Yeah.
So,
So what you described is, Troy, overall, I think it's good. It is a market environment in which there are a lot of opportunities. Volatility tends to breed opportunities, particularly for active managers. And Chris and I have spent our entire careers in understanding what drives the markets, what creates these sort of opportunities, and the ability to structure investment ideas or express our views. One of the good things, there's good things and bad things about this separate account management, structure that we have, but it has certain limitations in terms of what we can do. So we're reliant upon, from our view, create the best possible product we can, but then it's asset allocation decision that helps in this overall risk mitigation for our client's account. But there are other opportunities, and there's the opportunity to create other vehicles that allow us as an investment manager to express our views and take advantage of some of the stuff that we've talked about. And we'll just have to see how that plays out for our clients.
John, how you doing? I'm glad you tuned in here. Randy, so this was a pre-submitted question, and he wrote it in the comments. So Randy, thanks for tuning in. The stacking annuities question. So we were reviewing this, and we're starting to get into the Q&A. We're going to wrap this up in about 5-7 minutes. We're going to answer any questions that you have, cover a couple of them that were pre-submitted. If you have any questions, please put them in the text box now. We're going to spend the next 5 to 7 minutes kind of rapid fire answering questions. Randy says, what are your thoughts on stacking annuities? So Stacking annuities is where you put 1, 2, 3. Let's say you're going to invest $500,000 in principal protected, guaranteed lifetime income, fixed contracts. And you're going to break that up, let's say 150, 150, and 200, or 200, 150, 150. Stacking would mean I plan on taking income in 5 years from the first one, and maybe 8 or 10 years from the second one, and 13, 14, 15 years from the third one. So you create a guaranteed stream of increasing lifetime income. It can be a great plan. If you don't like the stock market, if you don't like the risk of your principal possibly losing, if you don't know where your income is going to come from, it's guaranteed lifetime income. And to have a stream of guaranteed lifetime income that's increasing, especially if you start to integrate tax planning and make that tax-free through Roth conversions, it could potentially be a very viable strategy. You need to understand, of course, the terms and conditions of various annuity products out there and pay attention to the fees with variable annuities. I would go personally the direction of fixed or fixed indexed annuities. They tend to have higher guarantees and stronger income. But it can be a very viable strategy. It's things that can help the portfolio. Okay. Someone said, "What is a buffered ETF?" And then never mind.
So
good job
I will say something good about them. They're better than ETNs, which is the notes.
We're going to go down there.
No.
So anything triple levered, right? Especially, that's another thing I just bring up while we're on this conversation.
Yeah. The structured products group, with whether it's ETNs or ETFs or whatever, they look great on paper, and I have yet to read one that I wanted to buy. I could work the math out that it wasn't just easier to go, simplistically go buy the S&P 500 and go buy a put, and it's a lot cheaper, and you'd get the same results, and you wouldn't have to, pay fees to whoever's managing the money way behind the scenes and stuff. So, and the one Troy brought to me, I was like, oh my God, this looks great. And I looked at it, and it took me about an hour or two. And I'm like, oh, this scenario, it's fantastic. This scenario, fantastic. And I'm like, okay, wait a sec. If the market is down 20%, I lose dollar for dollar, 20% and more. It doesn't go from, just a little bit.
On that first
you drop from, okay, I'm safe to you're down 20 and dropping. Yeah. And I'm like, no, that's not good.
Okay, so a question: we can't give personalized investment advice, of course, but it brings up a few different thoughts in my mind. So this is from Philip. I'm going to leave your last name off here, but Charles, he says, is a 60-40 or 70-30, what type of fixed income investments, I think that's a better question or better direction to go here. What type of fixed income investments do you think are prudent for retired people in their 60s and older?
Yeah, I think right now, just, those sort of asset allocations make sense on the fixed income side, kind of as we talked about earlier. Short-dated, treasuries are very attractive, and then you can still find investment-grade corporate bonds that you can pick up an additional percent and a half yield that provide very attractive returns currently, and safe. That your capital is safe, and you'll have it back in a year or year and a half, and take care of the reinvestment of that at that time.
For the first time in almost 15 years, the municipal market is looking fairly attractive.
Well,
and so now when we start to get into tax planning and investment allocation, it comes down to what's your income level? Is it more attractive to put money into tax-free municipal bonds or short-term corporate or government treasuries or even money markets?
We do. We looked at that, and I was kind of surprised. I'll counter what you said a little bit. Sometimes they are. The municipal market now is actually pretty rich, or it's not as attractive at the core as the treasury market or the corporate market is currently. And the way we look at that is we say, well, what is the taxable equivalent yield on these muni bonds? And of course, what I was looking at was a composite across all 50 states of investment grade bonds. But I think we were chatting just the other day, Chris and I were, and looking at where yields were on muni bonds across this time continuum. And there's an interesting phenomena that we observed, and it's that bonds offer less and less yield as you get towards about 8 years out. which is right when it's projected that Social Security is going to run out.
That's interesting.
And the expectation would be that people are thinking that your tax rate's going to go up, right, to help
That is
offset
interesting.
Social Security. So there's an interesting spot in the curve there that leads us to believe that. But yeah, muni bonds from time to time can be very attractive opportunities as well. It depends upon your marginal tax rate.
You know what's more interesting there is the capital markets or the bond market, which typically the bond market is far more intelligent than the stock market or equity investors. What it's saying is they actually believe that the government is going to kick the can down the road for 8 full years until the Social Security Trust Fund technically runs out of money to fulfill 100% of their obligations. So that probably raised a lot of maybe concern or fear for some of you. The Social Security Trust Fund is not going to be completely bankrupt in 8 years. It's just going to be able to be projected to cover 75% of its liabilities. Don't worry about the 100 trillion or so of unfunded liabilities the trust fund is on the hook for. So no, we don't have big concerns about it, but there are some concerns there for means testing, possibly for people who have a significant amount of wealth. Just an opinion, not fact. But we just saw a new rule. We're going to close it out after this. This is an important new rule. So if you're still working and you make $145,000 of Social Security wages. So Social Security wages are your income without being able to subtract your 401k contribution. So it's how much is taxed for Social Security or FICA purposes. Your catch-up contribution, if you're over the age of 50, $7,500 currently can go into your pre-tax part of your 401k. So you can put $22,500 and then an additional $7,500. I believe it's 22, somewhere in that range. I think $7,000 is the catch-up. Either way, in 2026, if you make above $145,000, you can no longer put that catch-up contribution into the pre-tax part of your 401k. You are forced to put it into the Roth part of your 401k. And I talked about this on the radio show this past week. I actually think it's pretty intelligent on behalf of the government because, first and foremost, there's, relatively speaking, not many people who are making that catch-up contribution. Then, out of that pool of people, not a lot of them are making over $145,000. If I had to guess, maybe 50, 60% of them. But the kicker is most of those people are already considering or already putting it into the Roth part of their 401k. So it was super, super low-hanging fruit. And I don't think it's a ton of tax revenue, but it is a step into that direction to where we're going to create policy that says you can no longer do this from this point forward. Here are the rules. And it creates a little bit more tax revenue. And guys, I think this is something, not to get into this conversation maybe at the next live stream, but this is something I think we're going to start to see a lot more of over the next 10, 15 years where, hey, from this point forward, here's how taxes work.
Yeah.
So any closing thoughts?
Wow. Capital markets are dynamic. They're forward-looking. That's the way we approach them. We think it's the right approach. We try and tune out the noise, do what we think is best, what provides the best risk-return opportunity. And that's our basic strategy.
Year to date, it's been a very normal summer. Normal year as far as returns on the stock market, regardless of what you've heard on TV. We expect the rest of the summer to kind of play out as such, which means 4 to 6 weeks of kind of mess, which would put us into mid-October, and then we'll see. If you start hearing on TV the Fed's starting to talk a little dovish, you see the economic data, which we see coming in weaker, that actually would not be a bad thing for stock returns into Thanksgiving and Christmas.
It comes back to 2012, 2013, 2014, where bad news was good news.
Yep.
Yeah. Thank you guys very much for tuning in. We're going to do this monthly, and we look forward to seeing you on the next live stream.